Welcome back to the Explainer. So today we're tackling something that is literally at the very heart of financial success: mastering business income. Look, if you've ever stared at tax legislation and felt just completely overwhelmed, trust me, you're not alone. But think of our journey today like a giant mathematical funnel. We're going to pour all those complex rules, regulations, and raw data right into the top, and by the time we hit the bottom, we'll have distilled it into a crystal clear understanding of exactly how business income is calculated. It's actually a pretty fascinating system once you see how all the moving parts lock together.
All right, here's our map of the maze for today. We're hitting 6 main areas. First, defining business income. Second, the income calculation formula. Third, disallowable general deductions. Fourth, allowable specific deductions. Fifth, mastering capital allowances. And finally, number 6, navigating business losses. Let's jump right in.
Section 1, defining business income. Before we do any math, we really need to clearly define the playing field. You know, it's actually fascinating how specific the Inland Revenue Act is here. According to Section 195, a business includes any trade, profession, vocation, or even just an isolated arrangement with a business character, no matter how short it lasts. But, and this is a big but, notice that strict exclusion: employment, right? So the crucial takeaway here is that if you're earning a standard salary as an employee, you are not operating a business under this definition. We are strictly talking about commercial enterprise, trading, and professional services. Okay, moving on to Section 2, the income calculation formula. This is going to be our anchor for everything else we do. And here is our funnel in action. See, when you calculate taxable business income, you don't just use the profit your accountant hands you. It's a process. Starting at step 1, we take your broad accounting profit or loss. Then step 2, and this can feel a little backwards at first, we actually have to add back certain expenses that the tax law explicitly says you cannot deduct. These are the Section 10 disallowable deductions. It's basically how the government makes sure only legitimate business costs are claimed. Okay, so once we've added those little traps back into your profit, we move to steps 3 and 4. This is where we subtract the allowable deductions, the expenses you are legally permitted to claim under Sections 11 through 19. And the result at the very bottom? That's your final assessable business income. Section 3, disallowable general deductions. We are now entering the cautionary no-go zone of Section 10 to identify exactly what you cannot deduct. So if you've already deducted things like personal home expenses or, say, a night out for entertainment to find your accounting profit, well, the legislation says you have to add them right back. Section 10 does not mess around. You absolutely cannot deduct domestic or personal expenses under Section 197. You can't deduct taxes or specified levies like the VAT on financial services. And here's a huge one: fines and penalties payable to the government for breaking the law. I mean, the government isn't going to subsidize your speeding tickets, right? Plus, any outlays for entertainment, lotteries, betting, or gambling, strictly disallowable. Unless, of course, gambling is your actual primary business. These are the classic traps to watch out for, and spotting them is absolutely crucial for mastering your business income. All right, Section 4, allowable specific deductions. This covers Sections 11 through 19, and we are finally shifting into the green light zone where you can actually save some money. To figure out what's allowable, we have to grasp a pretty fundamental rule in taxation. It's the hard line between revenue nature and capital nature. Section 11 allows deductions for expenses incurred in the production of income, but it completely separates these two. Revenue expenses, those are your day-to-day operational costs. Think office supplies, monthly rent, electricity. Those are immediately allowable. But capital expenses, which Section 11 defines as securing a benefit lasting longer than 12 months, like buying heavy machinery, those are not allowed as a standard deduction. You can't just write off the entire cost of a new factory the year you buy it. It's an essential distinction that totally changes how you need to approach major business purchases. Let's take a quick mental break here and look at a very specific allowable deduction under Section 13, trading stock. This simply refers to assets owned by a person that are intended to be sold in the ordinary course of business. We're talking work in progress, raw materials, consumable stores. This stuff is literally the lifeblood of a retail or manufacturing business, and the tax code treats it with its very own set of rules. Calculating the deduction for your trading stock is wonderfully straightforward. Seriously, it's just basic math. You take the opening value of your trading stock for the year, add the expenses incurred to acquire more stock, like freight charges or purchase costs, and then just subtract the closing value of your stock at the end of the year. The resulting figure is your allowable trading stock deduction.
It's a clean, logical way to ensure you're only being taxed on the inventory that actually moved through your business during that specific year. But wait, here is an incredibly interesting exception that honestly surprised me. Remember a minute ago when we said capital nature expenses aren't deductible? Well, Section 115 provides a brilliant little shortcut. To encourage innovation and growth, the Act explicitly permits you to deduct research and development costs and even agricultural startup expenses, like clearing land for cultivation or buying livestock, even if they are of a capital nature. It's a massive incentive. The only catch is no double dipping. You can't deduct the cost of purchasing R&D equipment here if you're already claiming capital allowances on it somewhere else.
Section 5. Mastering capital allowances. Time to tackle the heavy machinery and those massive capital expenses that last longer than 12 months.
So, if you can't deduct the cost of a massive crane or a new office building all at once, what exactly do? You claim a capital allowance under Section 16. Think of this as a slow-release tax benefit. Capital allowances are granted for depreciable assets. These are assets used to produce income that will inevitably lose value over time due to wear and tear or just becoming obsolete. Now note that this totally excludes things that don't suffer wear and tear, like land or goodwill. So you are essentially getting your tax deduction, you're just spreading it out over the useful life of the item.
The Inland Revenue Act is incredibly organized about how this works. The fourth schedule categorizes every asset into a specific class with a set number of depreciation years. For instance, notice how a Class 1 asset, like a computer or data equipment, depreciates over 5 years. Meanwhile, a Class 4 permanent building takes 20 years. And look at Class 6 down at the bottom. If you buy milking machines with the latest technology to manufacture local liquid milk products, the government lets you depreciate that in just 2 years. It's a really cool example of tax legislation being used to actively stimulate a specific local industry. In calculating it? Surprisingly simple. The fourth schedule uses a highly logical straight line method. The formula is literally just capital allowances equals A divided by B. A is the depreciation basis, meaning the actual cost of the asset, and B is the number of years dictated by its class. So let's say you buy a million-rupee machine that falls into a 5-year class. You get to deduct a fifth of that cost, $200,000, every single year for 5 years. It perfectly smooths out your tax deductions, turning those massive capital investments into predictable, manageable tax relief.
And finally, Section 6, Navigating Business Losses. We've added our traps, we've subtracted our allowances, but what happens if that final number at the bottom of the funnel is negative? That brings us to Section 19. This is the ultimate safety net for business owners. And the absolute most important number to remember here is 6. If you run all these calculations and realize your business actually incurred a loss, the Act allows you to deduct that loss from any other business income you have that year. But if you still have an unrelieved loss left over, you don't just lose it. You are actually allowed to carry that loss forward to offset your profits for up to 6 previous or future years of assessment. It basically ensures that one bad year doesn't just permanently wreck your long-term tax strategy. It gives you a massive 6-year window to recover and rebuild. And there we have it. We've made it completely through the funnel, from raw accounting profit all the way down to the final rules on losses. So now that you know the rules of this game, you know what you have to add back, what you can immediately deduct, and exactly how to utilize those slow-release capital allowances, how are you going to restructure your spending to truly master your business income? I mean, will you invest in R&D to take advantage of Section 150, or maybe rethink your asset purchases based on the fourth schedule? The legislation is incredibly complex, for sure, but as we've seen today, when you break it all down, it's really just a formula waiting to be optimized. Thanks for joining me on this explainer, and I'll catch you next time.